Well, how you doing today?
Another day, great day. It's actually started snowing in northern Michigan, which was not
Nice.
fun. But, you know, we take the warm days when we get them, and it's been warm. So a little bit of
Yeah,
snow here and there is okay. But
good.
yeah, I'm
So,
doing good,
are you in the Upper Peninsula?
man. I'm the closest you can get pretty much. I'm about 20 minutes away from the bridge to connect the lower and the upper. So very
Mhm.
close.
Okay. I haven't been up there, but um, I hear that that area up there is not unlike uh, us down here in Texas as far as the people go.
Yeah, it's. I'll tell you, in the area I live in, people are friendly, people are nice. Um, I live in kind of I would say, a ritzier city for northern Michigan, so we kind of get a little bit of those ritzier kind of, I don't know, prissies up here. But I would say, on average, people are pretty nice.
Okay, good. So it's a little bit of a rural area, a little bit more, not big metro areas.
Yep, pretty rural. I'm a small town guy. Grew up about 20 minutes from here in a neighboring city. Well, probably more like 40 minutes from the town I live in. And very rural. Like, I think growing up, we had in the city was maybe 5,000. I think it's grown to maybe like 8,000 now.
Yeah.
So yeah, you could say that's pretty rural.
So tell me about yourself a little bit. What's your background? We've known each other for a long time on Facebook, and we've met
Right.
at least once at 8%, but I haven't really gotten to know you, personally very well. But like to do that right now.
Yeah, absolutely. So I have a weird, well, maybe not as weird anymore. A lot of people have unique stories, but I would say it's a little bit of a unique one. So grew up in rural city called Sheboygan. That's with a C, Michigan, versus Sheboygan with an S, Wisconsin. Um, Grew up, high school, everything. Graduated high school, went to Fair State University College. My first year there, I actually joined the military, joined the Army as a reserve soldier, an 8-year contract. So I went to school, did the Army thing on the weekends, and studied criminal justice. So I got my CJ degree after 4 years, went through the police academy, became MCOL certified, and was on the hunt to search to be a cop. The very first place I applied to, made it all the way to the end. It was a city not too far from my hometown that I really wanted to work in, and got a conditional job offer. Got my FTO training book and started studying that. I moved to that city, got my uniforms and everything, and it was the day before I was supposed to start. I got a call from the hiring lieutenant that said that the sheriff, who I had never met, rescinded his job offer, and I never knew why. I never knew why at all. Still to this day, don't know why. I just took that as a sign, and went back, started hiring or started going through hiring processes. And believe it or not, the same thing happened. I was 2 weeks away from starting this time, and they rescinded a job offer. I had already been through the background, everything crystal clear. Still don't know. All I know is that there's a higher power that didn't want me to be a police officer. Got into the insurance world shortly after that, as a captive agent. Went from being a captive agent to independent with an investment advisor. Taught me a lot of stuff. And then a year and a half ago, started my own independent insurance brokerage, and just taken off from there. So that's my background.
Great. Man,
Long
that's
story.
good. I didn't know the law enforcement part. I knew that you had been in the Army, but I didn't know that you went through the police academy and everything. That's great.
Yeah.
That stuff happens, especially in small areas. You never know. And sheriffs, they have the power to do those kinds of things. So yeah, who knows?
And I'm glad they did, because I love what I do now, and
Yep.
I would never go back and redo anything. So
Me
apparently,
too.
I found my calling.
I just finally retired. I've been a reservist with the constable's office here for the last about 8 or 9 years. And finally just retired from that even completely. Just don't have time for it because I love what I do here so much more.
Wow. That's
Yeah.
awesome. Good for you.
Yeah. 23 years was enough. That's good enough.
I'd say that's enough.
Yeah. Yeah. So, but you're an independent insurance agent now, just like most of us are here. And you primarily specialize in Medicare.
Right. Yep.
Seniors,
that's how I've built it up.
Retirement planning. So kind of tell me a little bit about your practice and
Sure.
and how you structured your practice.
Yeah. So just like I would say, anybody who's out there and just wants to grow as quickly as possible and help out as many people and just stay busy, I took the route that was going to get me in front of the most people the quickest and easiest. So if that took money to do that, I did that. So I started doing a lot of seminars when I didn't have any money to purchase mailers or whatever. I did a lot of seminars and networking and referrals and just cold calling and got in front of as much people as possible. Mostly focusing on Medicare, doing a little bit of life insurance, got into the annuity space, started doing a little bit of the annuity stuff. And once I got some capital, I started doing, okay, well, my time is valuable now. So how can I make sure that I'm not spending a lot of time trying to get in front of people? I want to get in front of people as quick as possible. So then I started doing the mailers and the Facebook advertising, and my networking started to get wider and wider, and more people referring business to me. And then I started contracting some agents, and then that is where I really I know my own worth, and so that's where I started doing a lot more of the kind of financial products like annuities, because I just came up a lot. When you're dealing with Medicare, a lot of people out there are right for certain products, and I knew there was a big market there. So a lot of what I do now during the off season is holding appointments and sitting down with people until the off season, and then just hitting the financial side of things pretty hard.
Yep. So I find I do a lot of a business, annuity business in the first quarter. Really, January, February, March is probably my most productive time, because I've had all these conversations back during the annual enrollment period when we're scrambling to get Medicare plans and prescription plans reviewed and changed. But we also bring up the money conversations, and we put those off usually until January, February. And so that's when the majority of my production takes place, because we've had those conversations. And then, the rest of the year is just new business, new clients, new business.
That's super important to make sure you're having those conversations when you're sitting down with anybody. It never hurts to ask, right? And that's going to set you up for helping in a lot of other ways down the road. So that's good.
That's right. Can you take us through just about 5 minutes of your process? How you meet people, how you not your whole Medicare pitch, but kind of how you set them up to get to the money part.
Yeah, absolutely. However I get in front of that client, whether it's through Facebook referrals, whatever it is, once I'm in front of them, it's pretty much the same process. I would like to say that I try to be like silly putty. I try to be as flexible and mold myself based on that client's personality, which I think is really important. And it's not something you're probably going to develop in your first couple of years of doing the business, maybe. But when you can reflect on the way that client or prospective client's personality is and kind of jive with that, you're going to develop a relationship pretty quickly and develop trust. But when I do, sorry, I want to turn my phone down here. When I do sit down with a client and I'm in front of them, for me, gaining that person's trust is extremely important. If I have 10 appointments lined up in a day, and that person wants to sit there and just chat about stuff with me, I will put off. I don't like to cancel appointments or push them back. But if it's really important to that person, I will sit there and I will talk to them about whatever they want. I just got done with an appointment. It was with an existing client, but he sat there and talked my ear off for an hour and a half before we got any business done. And that was completely fine, because I love building up relationships. And when you're building that relationship with that client, they're not going to go anywhere. if there's an issue, they're going to call you. They're not going to call, whatever company you have them with or whatever. They're going to talk to you, and that's really important. So doing my initial, I guess you say just building my relationship and rapport, I guess, building that rapport with that prospective client is super important. Once that's done, it's kind of business from there on out. So I do my fact finding just like anybody. I just say, hey, I got a couple questions here for you. We go through the fact finding, and in my fact finding, I created my own fact finder. I didn't like a lot of the generic ones out there because there are certain things that I want to hit on, that I want to know, that are really important for me. When you're asking people in your fact finder about income, and you're supposed to be talking about Medicare, a lot of times they're going to ask you, what do you care about my assets or my income for? And I always revert back to, well, because there's a lot of assistance types programs you might be able to qualify for within the Medicare space, such as the Medicare Savings Program or LIS. And it's like, all you got to do is tell them that. And it's like, oh, okay, well, here, I got 500 grand and whatever, Yep. A lot of times they'll tell you. If they don't, that's totally fine. You just haven't built up that relationship with them yet, but don't give up. Don't give up. You don't have to be pushy right then and there, but put it on the back burner. Bring it up later in the conversation. Once you've provided value on the Medicare side and you know what you're talking about, and I know a lot of agents out there don't do Medicare to get there. I do. Okay. But once you have that built up and you can show them that you know your stuff when it comes to Medicare and other types of insurance, later in the conversation, they might just open up about the financial part, especially when, for me, I brand myself as not only an insurance person, but also an analyst, because that's exactly what I do. I analyze people's finances a lot of times and just give them the overall gist of it. I don't necessarily give them, investment advice. I can't do that because I'm not securities licensed, but I can analyze it, which is completely fine. When people understand that as well, they see it on my business card or the packet that I give them when we sit down. When they start seeing, oh, hey, look, he helps in retirement, this and that. What exactly you do? People, inquiring minds like to know. So once I'm done with my fact finding and I'm done with my Medicare stuff, if I see that in that fact finding there's some opportunity, even if I'm not sure what exactly the opportunity is, I'm always going to go back to it. I'm either going to set up a second appointment with them, or I'm going to hit it at the end of the appointment. I don't really give up. I don't give up unless that person asks or tells me that they are seriously not interested in having that conversation. And even then, sometimes somebody had told me that down the road, built up a great relationship with them, and then they opened up. So I'm not a quitter, but I'm also not overly pushy. There's always that perfect porridge in there, is what I like to call it.
Yeah, I think it's very important that you start out with explaining to them why you're going to ask the questions, how it applies to what you're there for when you're there for Medicare. Not only may there be programs available if they have low income, but if they have high income, high assets, there may be some penalties, and IRMA,
right?
Things that come along. So if I ever am questioned on that, that's what I tell them. Number one is suitability. The state requires that I do some due diligence to make sure that I'm making the right recommendations to you, and we want to make sure you're not going to pay any penalties, or if you've got some tax advantages that we can take advantage of, then I need to know the answers to these questions. So I usually don't ever get any kind of pushback because I set them up, properly in the beginning. It sounds like that's exactly what you're doing as well. So when you get them in that second appointment, I know you've got a pretty cool pitch for annuities, and can you share that with us?
So every client's obviously going to be different. They're going to have different goals, right? Mm-hmm. So when I'm able to get them in talking about the financial side of things, or their retirement goals or whatever it is, when we're talking about money, we're talking about assets. I have a different fact finder that I use, and once I qualify myself, and that's kind of how I started. So I go back and I revert back to what I did during the Medicare side, only it's different. So now I'm qualifying myself as a professional in knowing what I know about certain financial products and why you're even talking to me to begin with. And I'm telling them things that, hey, investment people do this, brokers do this. This is what I do. Okay, this is what I specialize in, right? And if this is something that you don't think is a goal for you, give me 5 minutes or 10 minutes, and maybe I'll show that it should be a goal. Or we don't ever have to talk about this if it's something you don't want. And sometimes that does happen. I've sat down with clients that have millions of dollars who they could care less about income. They could care less about legacy planning. They could care less about X, Y, and Z. They risk, low risk. They just did not fit the annuity side of things. Totally fine. That you can walk away from that with your head held high, and maybe the next time the market crashes, give them a call, right? So when I'm sitting down with these clients the second time, I'm doing all of that. I'm doing a different fact finder, and now I'm asking a little bit more specifics, and a lot of it's goal oriented, right? I care what their goals are. I actually have a fact finder right here in front of me. So mine, I want to know about leaving a legacy, if that's important to them. What about leaving money to your heirs? Financial goals, right? You can have two of these three things. You can have liquidity, you can have growth, and you can have no risk. Which of those two are important to you, right? Seeing how they answer that and let them talk, right? I'm a talkative guy, if you can't tell. Sometimes I have to shut up and I have to ask them a question that's very open-ended and have them tell me about what they want in their goals. If they're sitting there talking about their grandkid for 20 minutes and how proud they are and how they love them, that is something you need to write down. That is important to them. Their grandchildren, for a lot of seniors and retirees, are super important. That is where a lot of wealth transfer and legacy planning and whatnot, you can really pivot on that. So once we figure out what the goals are, and I figure out if they're right for the products that I offer, that is when I might even set a third appointment and kind of spread it out now that I have a good idea. Or I've already prepped. I already kind of know from the first appointment how much money they have, probably maybe how much I would put in a financial product that I offer. Maybe I already have that, and it's in the form of a nice binder I put together. I call it a financial needs assessment. And maybe we go through that at that time. Okay, well, based on our previous conversation and also what you just told me, I think I have something that might be right for you. Let's talk about that and why. And I always make sure that I am talking not about the pros, but all the cons. If there is a con in a product you sell, talk about it. Get it out of the way first. Because the last thing on somebody's mind is something that a lot of times that'll stick, right? So get the cons out of the way, go right into the pros after the cons, address all, if they have questions about the cons, address them, and then talk about why you think it fits their situation. Make sure that client or prospective client, any hesitancies they may have, you're going through all of that. You don't want them to leave that appointment with any type of, like I said, being hesitant at all. You want them to be educated, to make an informed decision, so they can walk out of there thinking that they're a rock star and they know and they're confident that I'm going to take care of them and this product is right for them.
That sounds great. You've got, I'm sorry, I wrote it down when we had our little agent hangout that when we were talking about annuities, but you've got five things to know about annuities, or 5 things that annuity. Tell me about that. I'm sorry, I'm not in my office today, but
no, that's okay. So I actually gotta pull that up because my 5, the 5 doesn't necessarily change, but there's a generic 5 when talking about annuities when it comes to like training purposes, and then there's the 5 there's the 5 things that you want to know if you're in front of a prospective client. I'm sorry, what they would want to know. So I have both, and I can pull it up real quick. Pull it up for you. Sorry, Ron, you caught me off guard with that one.
I thought it was real cool, and it's very simple and really, I think user friendly.
Yeah, absolutely.
Is a good way to put it for both an agent and a client.
Right, and that's a big thing when, from an agent perspective, right? You're going to want to know, at least with me, I want to know as much as I possibly can about a product in all of its entirety. I analyze. I'm super, I would say maybe even overanalyze a lot of times. And the reason why is I hate being caught off guard or not knowing something. It's perfectly fine for an agent to say, hey, I don't know that, but I can get that answer to you. Okay, that's okay. That is a much better answer than saying, I have no idea what you're talking about, or I'm sorry, saying lying basically, or trying to stumble and fumble over all your words to try to figure out an answer. Because a lot of clients are going to see through that.
Yep.
They're going to sift through the baloney. So just because you don't know something, there's no shame in that. But if you really want to make sure that you have all the answers, which you probably never will have all of them, but in a pretty good spot, make sure you're just studying as an agent. From an agent's perspective, just study up on your products. Do webinars. Go if you want to go sell a product, go join a couple of their webinars and really learn a lot about it. Get in contact with the rep that they have and have a question list for them. Sometimes you don't know what the right question is to ask. That's totally fine. You should have an IMO or an FMO or whoever that has an annuity person there that can kind of give you a good baseline. And things like these types of videos and webinars and training, you're going to get, sometimes it's a little bit from it. Sometimes you're going to get overloaded, and that's fine, because guess what? A lot of the stuff's recorded and you can take it in chunks, right?
Yeah, that's right. Exactly right. How about this? Actually pay attention to the product training that you have to take.
Yeah, absolutely.
Right.
Yeah.
Don't just click through it and sign the attestation and go do it. You gotta pay attention, because there's some gotchas you got to watch out for.
A lot of them. I'm still learning every day. I'm a pretty young guy. I haven't been doing this for a super long time, but the time in which I have been doing it for, I can tell you, I think I might differ than some, because I am always, and I mean like always, making sure that I'm getting as much information from something, whether I just watched an hour-long video and knew every little, and I pretty much knew everything except for this much. That to me was value, right?
Yep.
So, okay, so let's talk about the 5 real quick. So I have a couple 5s here that we had talked about on that other hangout that we did. So we have, let's see. So I have the 5 components that take away from an annuity. I have the 5 reasons why you should purchase. And then I have 5 tips for understanding, for an agent's perspective, 5 tips for selling an annuity. Okay. So let's do the 5 tips. Is that what you're looking at for?
Yeah.
Ron?
Yeah. I think it is the 5 tips.
Okay. So the 5 tips that I have when I'm talking with agents is, and we actually just talked about this. The first one was understanding your product, right? Like I just said, I overanalyze a lot of things. You don't want to do that. But if you're the type of person that processes information like I do, go at it. If you want to know ins and outs of everything, do it, because you more than likely will sit down in front of 100 clients and maybe one of them will be somebody who's like that. But that one person could have a $1 million, $2 million, $3 million account, and it could be right to roll over quite a bit of that, right?
Engineers don't get that much money.
So
that's who it is. It's engineers.
Right. It is.
That's the one dreaded client that
Right.
agents do not like to talk to. But
Right.
I bet you can sell engineers pretty good the way you are.
You know, I've sold to doctors, that's a big one. They're pretty, I would say, on the competency level, they're up there, right? And they a lot of times they got a lot of questions. But haven't had an engineer. If I do, I will let you know. So understanding your product is a big one. The next one is having a core group of, if we're talking about annuities, having a core group to choose from that are best in their specific prospective areas, right? So if it's an immediate annuity, go do the research. Go figure out what is the best immediate annuity on the market. Don't just take one person's word for it. Do some research. Don't be captive. That's what I'm going to say. Captive, you're going to drink the Kool-Aid, and you're going to have one person telling you something, and they're going to tell you it's the best. Think for yourself, okay? You're a broker for a reason, or independent for a reason, right? And if you're not independent, that's fine. I hope you guys offer great products. So have a core group to choose from, all right? The other one is, and this is funny, don't overanalyze, okay? When you are sitting down with a client, there are tons of different personalities out there. And this is where I go back to like the psychology of being a sales individual, right? You can call yourself whatever you want. At the end of the day, you sell a product. You are a salesman. You don't have to come off as a traditional salesman, but you are. Some people hate to be sold. Some people hate it when you overanalyze or give them too much information. That is why the fact-finding part and the building rapport part of the conversation is so key, because you're not only showing that prospective client who you are, you're also taking little nuggets from what they're telling you to figure out what kind of person they are. So you can now adapt your conversation into what you think they would want and need. Okay. So don't overanalyze. The other one is don't underanalyze. Some people want more information. If you dumb it down and you just say, yep, this is the best product on the market, you have to take my word for it, you're probably not going to go very, very far with that. Okay. How are they going to know? Especially when you're talking big clients with some big cases. Sometimes it's not very big. I did an $18,000 annuity, I don't know, 7-8 months ago, and they asked me every question in the book. Okay. I would say more
It's
so.
a lot of money to them.
Yeah, that's right. That's right.
Right?
18,
So the feelings are the same.
Absolutely. You got it. So just make sure you don't underanalyze either. And then finally, and I said this earlier, find the perfect porridge for the client. Make sure that you are not trying to make a sale because you want a big commission from it. Make sure you are making a sale because it's right for the client. Whether you think that 14-year product is right for them or not, if they don't think it's right for them, you need to go down in those surrender charges. Maybe you should look at a 10 or a 7, because if it's something that the client just, you really have to you're always running into that roadblock and getting that resistance, chances are you always will, right? So just make sure that when you're sitting down, you're finding the best product for the client. 50% of something is better than nothing, or 70% of something is better than nothing, right? Don't talk yourself out of a sale or sell yourself out of a sale. Okay. So that's my 5.
Yeah, that's awesome. Yeah, I think you hit the nail right on the head to not overanalyze it, but not underanalyze it too. And I really like to tailor it to the client. You know, as you said it perfectly. As you're doing your fact finder, it's not just to get the information, but it's kind of trying to learn about your client. And you know, annuities generally are not for sophisticated investors. They're for, you know, blue collar people that, you know, worked hard for their money and they don't want to lose it to the market, but they also don't want to take the time to learn about markets and mutual funds and stocks and bonds and dividends. And they don't want to do that because that's not what interests them. So they're happy to let you handle it, you know, through an insurance company, and they can understand, you know, safety. They can understand reasonable rate of return. They can understand principal protection. They can understand guarantees. And that's what they want, and they're perfectly okay with that. you're really more sophisticated investors are not interested in a 4 to 7% return
Right.
with safety. They don't mind taking risks and hedging and owning real estate and owning other assets that help with that. So yeah, that's perfect. Now we're at about 30 minutes now. Do you have some more time?
Yeah,
I'd really
absolutely.
like to get into the reason I invited you on anyway is you're one of the few guys that I know that actually really does get into the indexes and learns about all the different index options, and within the indexes, which ones are good, which ones are bad, and how they work. And I don't personally do that. I try to keep it simple. I try to stay with the simple ones, again, that the clients can understand. So the clients all know what the S&P 500 is, or at least they've heard of it. They see it on the news every day. And I can tell them, look, you're going to get 40% of whatever the S&P 500 does. And they're perfectly okay with that because they can understand it.
Right.
But there's a lot of hybrid and volatility control and actively managed indexes now. And you're one of the guys that I know that really gets into that and has made himself smart on it. And I'd like to kind of just get your thoughts on indexes and how you approach allocations within a fixed index annuity.
Yeah. This is
a big
for
question.
all.
I'll just let you talk.
This is for all the insurance agents and financial advisors or whoever does annuities. This is for all of you that have a pretty good understanding, but want to dive deeper. And you want to dive deeper, not for the 99%, but for the 1%. Okay, because for 99% of the clients, you won't need to know any of this. So understanding an index and how an index works. And by the way, I'm always learning about indexes. I still am finding out things about certain indexes that are way different than other indexes. So I think it's one of those things where you're never going to stop learning. But from what I know, to take it in chunks, how an index works. So, okay, so before we discuss indexes, like I said, understand 99% of clients more than likely won't care about this. Okay. So this is really for the 1 or 2%. When a client normally asks me about an index, I would probably say word for word with most of annuities I offer use some type of form of, at least for me, an algorithm that decides when and where your money should be allocated with the funds inside of that index. And basically it's a computer that does it. Okay. Some of it is an international index, and they put your money over in Germany and Japan and Europe and wherever, depending on how the markets are performing. And sometimes they move your money around in that index daily, monthly, quarterly, yearly, just depends on how that rebalances. But just know that basically, and I normally laugh when I tell them this, it's impossible or extremely hard to be able to do that as a human being, right? Especially from a daily perspective for thousands and thousands of people. So you just got to trust the robots. That's basically what I say. But for this more specific side of the index, indexes were created to track items. So trading stock or bonds, or a lot of times consumer goods or prices or for common goods, right? And there's millions of them out there. Okay. I don't know how many indexes are out there specifically, but I would assume there are millions. So in an index, in an annuity, basically works like this. The annuity company, and normally the companies that create indexes are like investment banks. Basically, the investment bank comes together with the annuity company and said, listen, we like your product. We want you to offer our index in your product. And we will sweeten the pot if you do that by giving you a bonus when you buy the stock options, basically. So that's that's happening when you invest in an annuity. I don't know if the term invest is right, but when you purchase an annuity, that money, the client's money, is now it's buying options into that index. Okay, so mostly call options, and this is where investment stuff gets in. So let's just say the annuity company says, all right, we'll give you a 60% bonus on those options. So if you buy, let's say 100 options or whatever it is, we're going to give you 160 or whatever. Okay. And that annuity company, because they're getting a 60% bonus, they're giving the client a higher, what we would call participation rate, right? So in an annuity, we all know there are participation rates, caps, spreads, fees, right? So in an index, you can have a par rate. So it's how much that client participates in that index, right? So if the index does 10% and your par rate is 80%, that means you are making 8, right? And it's all built in. So a lot of the products I offer don't have fees. That would be like a form of a fee that would be built in. But what if it's over 100%? What if it's a par rate that's 120 or 140 or 160? Well, that would basically mean that if that client went and invested on their own and actually invested in that index themselves, they would get less of a return than in the annuity. On top of it, they would also assume all the risk. So knowing that, you're not losing anything if it's over 100% par rate. So the annuity companies and the investment banks coming together with the indexes to form this partnership. So the annuity companies make a bonus from it, and then you actually get a higher return as a client. Okay, so that's really how indexes work. So the next question, and Ron, maybe I'll jump into a question real quick. A lot of people have is, how do you know if an index is good for the client, or how do you know if an index is right? Is that okay for me to answer?
Yep, absolutely. Yep.
So research. And it all boils down to research, right? So if you really want to know a lot about the index that you're offering your clients, it's okay to offer a product that you're really familiar with, and you've always used an S&P index or whatever, and you don't want to mess around with all these independent indexes or international indexes based on algorithmic data, whatever it is. You don't have to, but if you really want to pick a good one, and understand and being able to regurgitate to an engineer client, research it. Talk to the analysts at some of these insurance companies, or have them refer you to an analyst at the actual company itself that you're wanting to have the index for your clients. Past performance is not always going to be a great determining factor on how the index is going to perform. And the reason why is these indexes, a lot of times, they're getting better with algorithms, which is basically a math equation to determine an outcome in the future. And these algorithms are getting better and better, right? So whereas a computer has unlimited potential, it's really hard to say how they're going to perform unless they've been around a while. The problem is a lot of these indexes have not been around that long, right? So you really have to understand and trust and do your research to figure out, wow, well, 5 years ago, this did this, 5%, and last year it did 12%. How? Well, the algorithm is getting better and better and better. So understanding that, also, you need to understand that in an index with a participation rate, that participation rate does fluctuate, okay? Don't let any annuity company sell you on these high par rates which is great. High par rates are great, but you have to understand par rates are variable. So they change based on a lot of factors. Understanding market value adjustments as well, with the inverse relationships between interest rates and bonds. This is where you're getting into a lot of the investment side of things, which is why it is nice to maybe have a securities license to understand it. I do not. I brokerage my own accounts, and I know quite a bit about it. I prefer not to have an investment license personally, because I think I really like the Medicare side. Into a lot of the investment side. So, is there an echo in here?
No, sorry. I was checking on the other side.
You're good, man. Understanding that is important as well when you want to really get into the index and analyzing an index. And just understanding that the source of information that you're going to get to research all of this is going to come from a lot of places. Google or an IMO, or just go and do some research.
Yep.
These videos are helpful too.
Yeah. So I get questions from agents all the time. What annuity is best? What index is the best? And I always really just defer. It's kind of sounds like a cop-out answer, but it's really not. I think it's really a smart answer. Is, situation is going to dictate that, and you really need to rely on your marketers to help you understand it. So I'll have marketers call me, even the ones that I work with, and pitch me a new product or a new index, and I get them at that time to explain it in very great detail what it is and how it works and why it would be right for my clients. And I don't necessarily retain all that information though. So it's I've only got so much brain power every day that I can use. And honestly, for me, it bores me to a certain extent. That if I want to hear about the JP Morgan Mosaic 2 and how it's actively managed, and it has 5 different asset classes, and back cast results show that it's performed this well over the past 20 years, but it's only been around for 3 years. I don't know, that stuff. It's good to know, but really what I'm looking at is more on a really case by case basis. Yeah. For this client, is she looking for accumulation? Is she looking for income? Is she looking for estate transfer? That's what I'm looking at. Now, once we figure that out, then we can get into indexes and which one is best, which one is predicted to perform the best in the next year or 2 years. And so that's really kind of how I approach it. But I like the fact that you dig that information. And if I have a question, your marketers aren't always going to be completely objective.
True.
Because they're making money on these products as well. And, they might have a bonus this month from a certain company where they want to try to put a bunch of money into it. And so they're going to pitch it to you and try to get you to sell it. And especially when something new comes out or a new index comes out, especially with the indexes, they're going to have back-tested results, which aren't real. And if you've ever done any kind of trading like futures trading or really futures contracts, you can back test an algorithm, and it may look real good, but when it plays out in real life, it's not going to look the same. So if you apply those back tested results to a real world situation with the same ups and downs, there's slippage, there's human error, there's all kinds of things that go on that make those results come out different. So we want to see some real results over a period of time, not rely on back testing.
Absolutely.
But yeah, I just like the way that you get into that, and I'm glad that there's agents out there that do that. And I do, and more it's more important because just like you said, the algorithms are getting better. So some of these hybrid indexes are more appealing. I'm using some of the ones like the S&P Mark V.
Yeah.
Is been a pretty good performer. And I think, with what's coming up, I think it's going to continue to perform well. So that's where we're putting some more of our allocations. Par rates are coming down. So I never used to use par rate indexes, always just used cap rate indexes. But last year and the year before, we had some pretty high par rates, but those are renewing at lower rates now. So we've got to find other avenues.
Right.
I had one, I think, I don't know if I posted that in a public group or not, but had a security benefit contract that just renewed. It had a 40% S&P par rate year to year. Blew it out of the water. I mean, she had 15% gains in that thing.
Wow. But
it renewed at 35%. So we know that kind of especially on the S&P, par rates approach like 42%. I think 42% is the number. It will outperform the S&P over 10 years. But anything below 42%, you're kind of taking your chances. So, it's a good thing to know what those things are and know what the dogs are too.
Yes, right.
There's one that security benefit was selling just really big time in the last few years, and it's made like zero over the last 3 years. It just hasn't done anything. And then there's other ones like you talk about nationwide. We were having that discussion with that friendly discussion with the dude on Facebook last night.
That was fun.
And it was fun. You get a little bit more fired up about that stuff than I do.
I do.
I
Defending my buddy Ron.
By the way. Some of these things, they have 1 year crediting periods, they have 2 year crediting periods, 3 year, 5 year.
Yeah.
I try as much as I can to stay away from those because I don't want my clients to go 3 years without seeing any gains.
Right.
And maybe seeing fees coming out over a 3 year period before they get to see a positive statement.
Right.
In certain cases, you might need to do that. Like this case was an estate transfer play where we needed an annuitant-driven contract. That nationwide product happened to be the only one that I had available to me in Texas. And that product only has one index available, and that's the JP Morgan Mosaic 2, which is a good index, but it only has a 3 year allocation, 3 year strategy. So
yeah,
we go 3 years, and she's not going to see any gains for 3 years on that thing. So you have to be able to make sure that your client understands that, and that, okay, at the end of 3 years, we're going to see some money come into this thing. But for the first 3 years, you're going to see zero growth. But you're not going to see any losses either. So she saw no losses last year, but she's going to see some pretty decent gains this year. So that's good.
Yeah. Yeah. Those, it all goes back to understanding, the product, what you're doing, and just making sure that the client understands as well. Those par rates are, like I said earlier, they're variable, right? Sometimes, just like if you're a Medicare agent, you have teaser rates, right? A lot of carriers will come in with these great rates, and then they change them down the road, or they increase them. In this case, maybe they come in with a great par rate, and then they decrease it and give you some baloney as to why they decreased it. So, having a good track record, and talking about track record, there are indexes out there that aren't just hypothetical. Most of them are. There are historical indexes going back and actually looking at, this index has been around for 20, 30 years, whatever it is. How's it actually performed, right? Not just how they think it's going to perform. Sometimes that means a lot to clients. I think Sagicor, theirs is a historical index. So you can go to clients and say, yeah, this thing has actually done, not just telling you it's going to do, 7% or whatever it is on their 10-year product. I think it's around there. So sometimes that's important. When you're having that conversation with clients, they want real hard facts, not fiction.
Yep. I think something else that's important to note, and I think you said it, is you need to know that information, but you don't necessarily need to tell them.
Right.
Because the more you can give them too much information, you can over explain it, and you can confuse them, and the confused mind always says no.
Done it, been there, done that. Lost sales because of it.
Me too. You try to over explain it or explain it more than you need to. You go a little bit too far, and all of a sudden you've confused them, and they're out the door. They give you we need to think about it. We'll get back to you.
Yep.
And do they ever get back to you? Not once.
I caught myself doing that today. So about 2 minutes before I got on, I was just wrapping up an annuity sale, and the guy was already sold. He was a current client of mine, already wanted it. He told me he wanted it, and we were going through it. And I noticed I was getting off into the weeds a little bit, and I had to kind of reel it back in and just say, okay, this guy already wants this. Yep. He trusts me. I know what I'm talking about. Let's go back to the basics and then get through it.
Yep. Once they've given you that buy signal, it's time to shut up and get your pin out.
That's right.
Okay. So one other topic I wanted to cover real quick, and this wasn't the plan, but we talked about it in this discussion we had last night, was a suitable replacement. So you run across annuities, existing annuities that clients have. Maybe you sold them, maybe somebody else sold them. And you may see an opportunity to replace an existing annuity with a new annuity. And we know that there's boundaries that we can work within, but there's no hard and fast rules within those boundaries. We need to make sure we stay in the boundaries and don't have an unsuitable replacement. But within those boundaries, how do you approach that? If you see somebody with an existing annuity, what are the big things that you're looking for to make sure you're doing the right thing for the client?
Well, knowing what I know in the time frame that I've been doing this, I don't see very many good ones, right? So when I do sit down with somebody and they tell me they have an annuity, the first thing on my mind is always, I pray to God this is not a bad one. And 99% of the time, it's something that's just been a dog. And I try to keep my mouth shut until I actually look and can go over it. But that's how I approach it is, oh, okay, you have an annuity. That's great. When's the last time you reviewed that annuity and just kind of looked at how it's performed and, went over all the different riders and whatnot and fees? Oh, mine doesn't have any fees. Okay, let's take a look at it. I'll bet you they're in there somewhere. Reviewing it for the client. Once you review the annuity, if you determine from a suitable standpoint that there's something about it that just doesn't meet their needs. So a big one is that I've seen is this is guaranteed, right? Clients that come to me, they say, oh yeah, I have this guarantee rate. Oh, that's 6%. I'm like, no, you don't have a guaranteed rate of 6%. And they're talking about a rider for the income. Income guarantees is completely different. I'll give you a good example. Let's say that client tells me that. Okay. When are you using the income? Nope. Are you going to use the income? Nope. Then why are you paying 1.5% in fees for a guaranteed 6% in income when you make $100,000 a year and your expenses are $20,000 a year? Why? Right? Let's say there are surrender charges in that annuity, right? Let's take a look at the actual growth. How's it performed? Well, a lot of those annuities that give you those really nice high income riders aren't going to give you the greatest growth in the world most of the time. Some will. I'm not saying there aren't, but a lot of times. So if it's been a dog and it's performed terribly, and you just went over the analysis, their needs with them, and they really just want it for wealth transfer or to grow or whatever, that's when you need to start looking at, okay, this is suitable to put in a better product at this point, right? You need to make sure that they understand what entails moving it over into another product, right? If you have one you think that will perform better, okay, what does that entail? Is there a surrender charge they will have to pay? Can you offset that with a bonus if you can? You just have to make sure that you're educating them on making that decision. You're not just telling them about all the goods, right? You're not giving them all the goods and not giving them any of the negatives. So there are tons of suitability issues that we have to go through as agents, and they're there for a good reason, because many agents out there do bad things, unfortunately, or sell bad products. Sometimes it's just education. They don't know there's better products, right? So suitability is a hard one to go through, but just understand that if it's something you wouldn't do for your parents, probably shouldn't do it, right?
Yep.
That's how I approach it, or grandma, grandpa, or whoever.
That's a good rule to go by.
Very good. Unless you hate your parents. Hopefully you don't.
Hopefully. So, there's some opportunities right now, especially with MVA products, market value adjustments, where we've got positive MVAs, and they're actually so positive that overcoming the surrender charges. So I've been kind of letting agents know about these opportunities, because not only can you take get a client that's not yours, put them in a better position and make them your client, but you might be able to take some of your clients that you had in a product that's not renewed at as good a rates as it could have, and you can improve their situation. So insurance companies, for the most part, look at it the same way. As long as you're improving the client's situation, they're going to take that. And assuming their liquidity situation hasn't changed as well. So now, if they've spent all the liquid money, that's not going to be a suitable replacement to just flip it over. Right. But if their liquidity situation is the same, it's okay to replace an annuity with another one. If you're
absolutely
in their situation, if you're getting rid of a rider that they're never going to use, you're getting rid of fees that they don't need to be paying. If you're increasing their rates, you're getting them a bonus. You're doing all of that without a surrender charge, without them losing money. If they're net positive, you're good to go. There's nothing unethical about that.
None, not at all.
Yeah.
I've replaced quite a few and I'll just say the specifics here, variable annuities. Okay. Personally, I can't write them because you have to have a securities license. But the ones that I see around here, I'm not saying that all variable annuities are bad, but the ones that I see, they have anywhere between 2.5% to 3.5% in fees, and just do not perform well at all. Some have even more. I've seen upwards of 5% in fees on those products. And you sit down and it's like, okay, you've had this for 15 years and your $80,000 account is now 102 and you haven't touched it. That's terrible, right? So it doesn't mean you need to, as an agent, try to replace every single annuity contract you come up against, right? It is completely okay for you to sit down and say, that's actually pretty good, right? Because you're helping that client no matter what. You're helping them by saying you're in a pretty good spot. Pivot and try to find something else you can, help them with, whether it's Medicare or whatever it is, right? If you can't, you cannot do the right thing long enough without seeing positive results. And you're going to set yourself apart from a moral and ethical standpoint if you don't rush to go and sell something to make a commission. We all want to make money, but you're going to make money if you're doing the right thing. Promise you.
That's right. Yeah. And if you're leading with Medicare, they're already your client.
Yeah.
So you get an opportunity to review that annuity when it does come out of surrender. Right. And then you can get, or if you get, within 2 or 3 years of it coming out of surrender, when the surrender charges are lower, you may be able to overcome that with a bonus product. Who knows? You'll get that money eventually if you're doing a good job.
Absolutely.
Because eventually, those folks are going to want to consolidate. They don't want to make a trip to see you for their Medicare. They want to make a trip to Edward Jones for their finances. So the more you can do for them and help them consolidate, the better.
Absolutely. Yep. I agree.
Well, man, this has been fun. We're at right about an hour, and I really appreciate you coming on. Enjoy interacting with you in the Facebook groups. You going to 8%?
I am, man. I'm going to a lot of events this year. I'm ready and excited.
Good. So what else are you going to? Anything?
So I'm going to 8%. I'm going to an event down in Lake Tahoe. I'm going to the Bahamas with my IMO, which is cool. This is my first big trip I've qualified for, actually, because whatever reasons why. And then personally, I'm taking a trip out to Colorado, Alaska, and we might be going somewhere else. So we got a lot of trips planned this year. So super excited. I just had a baby, so I'm trying to work as much as I can to try to make some money so I can go enjoy the summer.
Good. All right. Any parting thoughts?
No, man. If you're an agent and you're watching this and you feel like, holy smokes, that's a lot of information that I don't know, relax. Okay. I hope maybe this can be some encouragement. I got my license 5 years ago. So in 5 years, which is not a very long time, I've learned what I've learned. And really, I've only really been doing annuities for about 3. So you can learn a lot in a short period of time if you put your mind to it. But if you don't want to know what I know or what Ron knows from the side of the intricate details, that's fine. I know a guy out there who writes a lot more than me by far, and he knows this much about annuities. Okay. So you don't have to know a ton. You just have to know what products help your clients as well. Okay. So don't get overloaded with all the information. That's my parting gift.
All right. That's great stuff, Tracy. I really appreciate you coming on. Have a great day. We'll see you around.
You too, buddy.